Howdy, Tex here with you, running you through some further info from the guide, which you would have read by now, rehashing some of the points here. Now, got to start off by saying that, as with any strategy or indicators or tools, they're not to be used as standalone items themselves. Surely there are certainly some traders that just rely on MAs or MA crosses in strategies to trade, which is totally fine. But whether you are trading with SMAs or EMAs, find the strategy that works for you and apply it to your current trading strategy. Don't just simply rely on SMAs or EMAs by themselves. So we know now the difference between simple moving averages and exponential moving averages is that our simple moving averages are very much that. They are simplified levels or simplified trend exaggerations to give you an idea of whether we are bullish or bearish within this particular time frame. Being a swing trader myself, I'm using 4, 12, and 1 day, and I'm using the 1 hour or the 30-minute for confirmation of an entry on the higher time frame. So the exponential moving average gives you a little bit more reactive data. The simple moving average gives you a little bit of, I guess you would say, lagging data, I suppose. And if you aren't familiar with SMAs or EMAs or moving averages in general, and you use the MACD, well, you are familiar with moving averages because that looks very similar to an MA, doesn't it? And it is. So you've got your signal line and you've got your MACD line. If you were comparing these to the two, your signal line would be your exponential moving average. The SMA would be your MACD line. Your MACD line would be the SMA because it's a more of a simplified moving average, and the signal line is giving you more reactive data. Now, where do I use these in conjunction with other strategies? Well, as the guide you would have read, I use them with Ichimoku and I use them with Fibonacci. I am looking on Fibonacci for levels of whether it be the 60, the 50, the 30, 38, the 23. I'm looking if an SMA cross occurs on one of those levels as an additional level of confluence that an entry or an exit may be valid, dependent on, again, is my steamroller nearing the top? Is my, and I'll show you the indicators that I have here. Now, you can see here I've got a number of indicators here. That's because I'm switching between multiple time frames, and I don't want to have to keep constantly finding the indicator that I'm using. So I just have all 4 here, and I block it out as I don't need it or as I don't use it. So looking at my indicators here, I've got what's called a WT cross, and that's what these highlighted candles are. I've got the ultimate MACD. The only difference with this and a traditional MACD is that it shows me levels where crosses occur, whether it be bullish or bearish. I've got a Stotch divergence. I'm using Stotch a lot more these days than what I am traditional RSIs and even CCIs for that matter. And Steamroller, of course, our custom indicator. So let's dive straight into it. I have a 10. We're going to look just at the SMA here. I've got a 10 SMA. And very simplified way, as the article suggests, is that we use SMAs and EMAs as a form of a visual trend. It is telling us the trend of the market, whether we are bearish, whether we are bullish, whether we're going down, or whether we are going up. It's a very simplified overview of what an SMA and an EMA does. Now, having just the 10 SMA on here, some people might just use this strategy and use it with great success to simply buy once we've crossed above and to sell when we've crossed below. A really simple strategy and yields pretty good results. If you back test the 10 and 20 SMA or EMA on the 4 hour or the 1 day on Litecoin or BTC, you would find that strategy to be pretty profitable. And it certainly works. But for myself, I'm looking to maximize every trade and not leave too much on the table. Now, a lot of people ask me, how do you use the smaller timeframes to look for early entries? Well, I don't really look for early entries per se. I look to confirm a bias that we are potentially heading up on the 4 hour. So I'll use the 1 hour for that. So I don't want to buy a break of just a single SMA because I would much rather wait for confirmation than simply just buying when it breaks through the SMA. I think that's a little bit too risky for my liking. So I'm happy to sacrifice 1 or 2% in the scheme of an 8 or a 10% move by looking for second forms of confluence. Now, what would that confluence be? Well, that would be a secondary SMA because, again, as the article suggests, you don't want to buy a break only to have it dump shortly afterwards. You don't want to be buying fake outs. And indeed, you don't want to be selling fake outs either. So how can we look for this secondary form of confluence using moving averages? And if you go to your indicators, this is just a multiple SMA. And for anyone else, you can use our Unicon SMA, or excuse me, our Unicon EMA, which we'll get into in just a second, but we're looking at SMAs at the moment. So you want to add a second SMA to this. So this is a multiple SMA fan, 10, 20, 50, 100s. The defaults were, excuse me, let me just cancel out that very quickly. I changed these because it was 10, 50, 100, 200, and you can add them to whatever you like. My personal preference is 10, 20, 50, 100, and then you could use a 200, or you could change this to 100, 200 if that's what your strategy entails. So the second way of avoiding or adding a level of confluence and avoiding fake outs is to add the 20 SMA. So we know here that when we have this breakout of the 10, we want to ensure that the second SMA is either pointing upwards to tell us that we are headed out of a trend, or we want to avoid buying fake out. So the strategy with a 10 and a 20 SMA is simply just to buy across, sell across, buy across, or buy across here, sell across. And you can see that that's a pretty decent strategy here, having just sold and bought crosses. Now, that definitely is a good strategy, but again, you might be leaving a little bit on the table. And how do you want to try and identify where these tops might be before potential reversals? Well, you would use your SMAs, of course, in conjunction with your levels of horizontal support and resistance, along with your trend lines as well. So don't just use the SMAs, or the 10 and 20 SMA, 50, 100, 200, 300, whatever you use. Of course, as we always say, use your levels of support, resistance, trend lines. You're baking a cake. We're laying it on. We're simply using the SMAs or the EMAs as levels of confluence for whether an entry or an exit is valid. The same again, as I mentioned, with Ichimoku or Unimoku with our crypto and standard settings. Our Tenkan and our Kijin, or our base and conversion lines, are very much like moving averages, although the calculations are slightly different, and they're not moving averages, but they are very similar. We buy a TK cross, we sell a TK cross. We use our base and conversion lines as forms of support and resistance. Now, going back to our SMAs, again, the simplified version of this is that when one breaks to the upside, we are bullish. When one breaks to the downside, we are bearish. Now, when we do break to the upside of an SMA, we are then using it as a form of support, or we're using it as a form of resistance. So the simple ways is that once the 10 breaks, the 20 becomes a level of resistance if we are moving to the upside. Once the 10 breaks to the downside, we're looking to the 20 as a level of support. And you can see how well this is respected here. Now, this goes a little bit further to what's called a Cradle strategy that was popularized by guys like Trader Cobb, where when both EMAs or SMAs are broken, we wait for pullbacks if you've missed the move, and you wait for it to sit inside this cup, or this cradle as it's called. And the same can be said for when we broke into the downside and we've missed a move, we've reversed, we are waiting for this cup here to be respected, and then a secondary form of confluence, or a level of a sort of a secondary confirmation that that move is correct, where you would look for something like a bearish engulfing, or in this case, a bullish engulfing. Once we have respected this cup, we are still trending and finding divergence between consider these like your MACD and your signal lines. There's divergence between them, that the distance between them is growing. Or we are converging here, meaning that a top is likely or a bottom is likely before they start to diverge yet again. So if we're using our 10 and our 20 SMA in this case, how do we look for a third level to help us identify where the top may be if we aren't using our horizontal support and resistance or trend lines? Like we can look there and we can say that that looks like a pretty decent top for that move. So that's cool. And then once we've broken downwards from that, we can see that our 10 SMA is starting to quite aggressively turn. And then second to that, our 20 SMA is also turning as well. And then we've got a second level of confluence here, along with quite significant selling volume, that this would be quite a respected level to look for exits. Okay, so the third way in which we can look for confirmation of where a potential top might be would be with a third SMA. In this case, it would be the 50 once we start to break down, and then the 100. So we can see that when we move to the upside, that this level was quite well respected here as our top level. So the way I see it with SMAs and EMAs is that the larger the EMA goes, or the more EMAs we got on there, the higher the SMA or the EMA becomes like a sort of a final level of confirmation of where we might be headed, whether it be to the upside or to the downside. This one confuses me a little bit, being the 100. We might just change that to 100 and 200. There we go. So that could be your levels that you look for, whether it be your 10, 20, 100, 200. So as I said, that the higher the SMA goes, I sort of see that as your last level of support. So had the 100 broken here, I would be looking towards the 200 as like a final level of resistance. But as the reason why it's good to have higher SMAs on there is because, as I said, it shows you the sort of top levels as well. But we know that the smaller ones are your more reactive. So from here, as it starts to curve a little bit, we know that we're starting to look towards a potential top for that move. And the overall downtrend, or the overall trend, and one of the benefits of using the higher time frame, or the higher SMAs, is that it gives us still a more macro overview of the actual trend. Whether it's respected as a level of support or resistance is great, but it's again telling us that we are still in a downtrend here until this level is broken. So looking at LTC now, it looks like obviously we're trending sideways, but it's looking like we could potentially be coming towards, at least on the 4-hour, a reversal point here, because we can see how high our top SMA was, indicating an overall downtrend, but now we're starting to consolidate. And if we can break above this, at least on the 4-hour, might be starting to signal that we are headed into an uptrend. So looking at the 1 day, is that the case? Well, yes, it is. Our 10 and our 20 are now looking to are converging on each other. And if we were to break above this level, and this is why I don't use the 100 and 200 so much on the smaller time frames, more so on the higher time frames, is because that once we break this next level here at around 6521, and our top level at around 6696 could be our top levels of support, of resistance. And we can see here the more reactive SMAs, your 10 and 20, were starting to curve here. And this SMA was really well respected as a level of resistance once this broke. So I hope that makes sense with your SMAs. That's a very simplistic way of looking for it. Now you can use an SMA cross. An SMA cross indicator, and we can look at the validity of those types of signals once they've crossed buy, sell, buy. Now, when you're using SMAs on the higher time frames, you're always going to have chop, of course, and that's where these signals aren't going to be too valid, and that's why you would probably put your bias back down towards the 4-hour time frame. But when we're looking on the daily time frame for further levels of confirmation, that's where your indicators start coming into play. So for a rule of thumb for myself is that I look for 3 forms of confluence before I consider a trade. One would be obviously the SMA cross. A second one from that is always going to be steamroller. So steamroller was quite accurate here in predicting that we were having a potential bottom of a move. We've got a confirmation here on our MACD. So we've got 1, we've got 2, and now we've got 3 levels of confirmation, but a very important one to this is volume. We've got a volume increase here, which helps to show me that, all right, we're on here for a potential move. We've got 3 forms of confluence plus an increase in volume. Our SMA is telling us the right thing here, and that's where I need to be listening. And again, the same thing can be said here with our sell indicator. We've got very little buying volume. We've got more selling volume, even though the selling volume was quite small. We've got a MACD cross here as well, and steamroller is now starting to point down and is breaching outside of these parallel channels, again showing us that we've got multiple forms of confluence, that our SMAs are telling us the right thing. So that's why we don't want to just buy here, sell here, buy here, sell here. You got to look at obviously the arc of the SMAs. Is it a sharp arc? Or are we simply just floating within a range here? And although that would be a great range, don't get me wrong, but if you are trading on the daily time frames, you want a little bit more confluence that that an entry or an exit signal is valid. So let's get rid of this. And you can see how it starts getting a little choppy now in this range. And that's probably where I would pull back a little bit from using my SMAs, and I would go to something a little bit more valid in terms of looking for levels of confluence amongst other indicators. What is my Fibonacci telling me? What is my Ichimoku telling me, whether it be crypto Ichimoku? We'll use standard Ichimoku for this because that's our bread and butter. What is Unimoku telling us at this time here? So if we get rid of our Ichimoku for a second, we've got a buy signal here. Does it align with something like our Ichimoku? Well, it does, because looking at that, we've got a TK cross here as well. So that's very much telling us that we've got some confluence there of a potential move. We've got a TK cross. We got our SMA cross very shortly afterwards, which aligned very well with this nice little pump here. And then we're using our cloud as a level of resistance, unless we want to start adding in more SMAs, being our 100 and our 200. So we can see that our top SMA aligns quite well with cloud resistance once we break through here. So that gives me a secondary form of confluence that these levels are quite valid and are to be respected, or looking to be respected. One thing that you don't want to do, though, is just rely on the SMA to the SAT, because that area can get front run. Not that everyone's looking at that exact same information, but my rule of thumb is try and be at least 0.5% either side of that, or 0.2 to 0.5% either side of that, looking for entries or exits, because it's not always going to be respected to a T like that. So that's using SMAs. Let's get now into our EMAs. The strategy and the principles behind this are very much the same. Once one EMA is broken, you look to the higher EMA as a level of resistance, and vice versa. If a level is broken to the downside, the higher SMA or higher EMA is then used as a form of support. Now, using the EMA, as I said, you can use the Unicon indicator. This comes from our Unicon, our Unicon indicator that has the EMA cross signal in it. And one of our members inside the inner circle brought this a little bit more to the forefront for us when it came to putting a little bit more weight on the EMAs. And again, whether it be EMA or SMA, they both have validity, but you've just got to really understand what works better with your trading strategy and what works better for you when you back test it. So as I said, I'm getting more into SMAs now, but if you are just using EMAs, you're going to see the validity in something like this, and how well how well the signals work put it sort of very bluntly. So you can go to Unicon, EMA cross signal, and you can change that to your own likings in here, whether it be using an arrow or a cross or whatever it is that you like. So again, we have, I'll just bring this up very quickly. We have our fast EMA and we have our slow EMA, and that's like our fast moving MACD. Our fast moving signal line and our slow moving MACD line. If you're looking at MACD, so our fast moving is our 21, our slow moving is our 10, and we can see here where buying a breakout would be unwise. If you just brought the breakout, you're going to get rejected here at the slower moving or the second EMA that's put there. So let's look back now at the strategy. Hang on, text. There we go. Looking back at the strategy now of just purely buying and selling on the break. Keeping in mind, when we are ranging sideways, these signals are less accurate. We really want more confirmed downward trends or upward trends to identify potential trend reversals. And this is why we have two, because this gives us a signal like a V bottom, gives us a signal much quicker than what our slower moving EMA does. So quite a good signal there. We've got a little bit of a chop, of course, but even here, still going to yield pretty decent results. And if we put on our time frames, rather, something like this. So 5% over 5 days for a basic hold, especially if you're trading on something like BitMEX or even if you're just buying spot, it doesn't really matter. 4%, and then you get these sort of unicorn ones, which are really cool. 10%, even to here. That's still 5%, but if you bought it directly on the cross. And keeping in mind here, we haven't even looked at anything else yet, like secondary forms of indicators or confluence or anything like that as of yet. So looking at just that over the course of So that's over the course of a couple of months, you could have yielded some pretty decent profits there. But again, if we even go back even further, or back rather to a higher time frame, if you're just trading on the higher time frames and using things like supply and demand as other levels of confluence, this is where I find this to really, really shine. 15%. 30% in a month and a bit, and we haven't quite got a long signal as of yet. So not a bad wicket over the course of a couple of months. It would have been 15, 45, 50, 60% in a couple of months. Just buying and selling based off crosses. That's it alone. And then obviously seeing here again, you've got an increase in buying volume, which gives you further forms of confluence. You've got Steamroller telling you that we're getting low to a position here. We've got our MACD crossing over. So even before we get to our EMA crosses, we're starting to get secondary forms of information that might indeed be a bottom. So that's why we use the 10 and 20 EMA, not just a single EMA. Very similar to the SMA stuff. It really doesn't change the strategy so much, just about whether you want more reactive or slower data. So let's look at this in comparison to the SMA and see how this may have worked using the two. And how you can use them in conjunction with one another. So very similar data, very, very similar data, although we get slightly more reactive information here on the SMA, a little bit more reactive here on the SMA over Unicon. But again, you're getting a little bit of chop here as well, whereas Unicon on the EMA has just said, hey, just hold this all the way through. Don't worry about buying and selling. And we can see here, Unicon's given us a little bit quicker information. The EMA has given us more quicker information than the SMA cross. And same again, where Unicon just said, just hold this all the way down here till we get a buy signal. So the signals are similar in nature, but we can see again here where we've got just a, hey, this is just a buy, this is just a sell. Don't worry about all the chop in between. So there's validity to both the SMAs and the EMAs. Using our EMA fan as well, we can see that when we get a sell signal on Unicon, where our final levels of support, I guess you would call it like our last line of defense, being our 200 EMA. We've got our 10, our 20 cross, our 100 becomes quite a respected form of resistance, and then our 200 becomes our sort of our last-ish level of resistance. And I use the 200 SMAs or EMAs and SMAs similar to what you would with your Bollinger Bands. We know that when we break outside of our Bollinger Bands, whether it be to the downside or the upside, and we've got quite a high distance between the top band and price, we need to have a little bit of a snapback. And the same can sort of be said for our Ichimoku clouds. When we are breached so far high and above or below our Ichimoku clouds, we need to have a little bit of a snapback, a little bit of a reset us to the equilibrium a little bit. And that's what our EMAs and SMAs also provide us, that type of information. So we've snapped out of here, we've come down. Now we need to have a little bit of a snap back. And then you're looking at price structure as well, and price action to confirm whether that was indeed a level that we should be looking as where we need to sort of return to the mean a little bit. So again, as we've broken out of the 10 and 20, our 50 then becomes, and these are the settings for the EMA fan, by the way, 10, 21, 50, 100, 200. We break through here. This becomes the next level, respected level of resistance. We break through here. This becomes the next respected level of resistance. We break through all three or all four. Our 200 becomes our next respected level of resistance. So, of course, our 10 and 20 is going to give you more reactive data here, but we know that as we start breaching along here, we're still in this overall downtrend. And that's the beauty of the higher EMAs, is that it gives you a more macro outlook as to whether we are ranging because everything's sort of tight, or we are still very much in this downtrend. If we take it a step further again as well on the daily, where we would look for this potential bottom, we know that we're trending a little bit here. We're still in this overall downtrend. Our 200 has started to turn. Our 10, our 20, our 50, our 100 are now starting to all turn. This looks like a pretty good level as a form of a potential bottom here. Steamrollers giving us the goods. We're starting to see a pretty decent increase in volume, particularly these volume spikes, and it's often well respected. So that's how we use our SMAs and our EMAs. Again, EMAs pointing up, bullish. EMAs pointing down, bearish. We break through the EMAs to the upside, bullish. We break through the EMAs to the downside, bearish. That's a very simplified way of looking at it. But using that in conjunction with volume, MACD, steamroller, RSI, CCI, any other indicators you might want to use along with it. Other things like our Ichimoku, Fibonacci, where things start to turn, that's where you can start looking for further levels of confirmation that the signals that the SMAs and the EMAs are giving you. So I hope you enjoyed that. If you do have any questions, feel free to ask over in the Discord, and use this strategy to your advantage because it's very simple, it's very popular, and can often yield pretty decent results. So I hope you enjoyed this. I'll see you for the next video.